As we look at the interest rate environment today, the key theme is the historical low yields. This low yield environment is not just a U.S. phenomenon, but rather a global theme. Most are familiar with the low sovereign yields in the weak Japanese economy, but the strong economies in Northern Europe are also at historical lows. Whether it is an attempt to stimulate a weak economy or safe haven appeal, the question on everyone's mind is, when does the rate rising cycle start? Looking more closely at the U.S., at a high level, the components of return for treasuries can be broken between a real yield and a compensation for expected inflation. Inflation break-evens are the market's implied inflation rate. This is the yield difference between treasuries and TIPS, Treasury Inflation Protection Securities, and averages between 2 to 3% over the intermediate term. While the balance of inflation risk is weighted to higher rather than lower inflation, recent CPI prints are supportive of break-even pricing. It's the negative real yield component which appears most disconnected from fundamentals. In the long term, real yields and real GDP growth track reasonably well. While the real yield curve trades negative through the 10-year bond, real GDP growth has been fairly resilient with 2% prints. Certainly unconventional factors are in play, with the most prominent being the quantitative easing programs of the Fed and the growth of the central bank balance sheet. Recent comments from various members of the Fed have hinted that the asset purchase program, the $85 billion per month of mortgage and treasury purchases, could be slowed by year-end. The market appears to be taking a "we'll believe it when I see it" approach, though, recognizing that the Fed would rather err on elevated inflation, something they have a successful track record with managing against, versus a debt deleveraging deflation trap. The mixed signals on the economic front haven't helped with respect to clarity. Strong corporate earnings and revenue results have been met with some weaker macro data. Spread compression was a big theme in 2012 in both the investment grade and the speculative grade sectors. While the rally in credit has certainly rewarded owners of this debt, spreads today still trade around historical levels. Low historical defaults, strong corporate balance sheets, and not least of all, the reach of yield have all been key drivers of the rally, and we view these themes to persist over the intermediate term. For corporate plan sponsors, interest rates play a critical role in the overall risk budget of the plan. While rate volatility affects the fixed income assets, they also drive liability prices. The largest liability risk factor is interest rate risk. Whether focusing on the corporation's balance sheet or cash flow profile, it is the net interest rate exposure which drives risk. While the warnings given today to private investors whose portfolios may have large bond allocations is well heeded, most pension plan sponsors have a large negative or short position with respect to interest rates. For example, a typical pension plan today, with 30% of the assets allocated to long-duration fixed income, still has a net duration of negative 9 years. The funded status of the plan improves if rates rise more quickly than anticipated by the market, even as the long bonds in the assets lose value. Generally, when we think about interest rate risk for corporate plan sponsors, we view interest rate risk as an uncompensated risk. The informational advantage in market timing broad rate moves is generally limited. Therefore, interest rate risk should be a small component of the plan's overall risk budget. It's better to concentrate the risk in higher Sharpe ratio strategies, such as alternative investments, as well as traditional investments, such as equities, but could have the low beta, low vol, or high dividend themes. The starting point in determining how much interest rate exposure to take is to understand what increases may already be priced into the market. For example, a flat yield curve would indicate an environment where consensus market participants expect yields to remain fairly constant. Whereas in an upward sloping yield curve environment, the one we have today, higher rates are priced in. The risk embedded in the short interest rate position, which most plan sponsors have, is not necessarily that rates go down, but rather they go up by less or at a slower rate than anticipated by the market. In addition to traditional approaches to hedging the liability risks, such as long bond strategies or overlays, interest rate triggers or option strategies can all be integrated with the plan's investment glide path. This can help balance the trade-offs between managing interest rate risk and the opportunity cost of locking in today's low interest rates.